The best defensive dividend stocks to buy. In volatile times like this, it's always nice to have a few steady and consistent stocks in your portfolio that are bringing in a decent amount of dividend. Defensive stocks are stocks that are considered safer. They might not offer the same opportunity for massive gains that more aggressive stocks do, but they come from sectors like consumer staples and healthcare that are expected to perform in essentially any economic conditions. In this video, I will discuss some of the best, most popular and most used defensive dividend stocks. Some of them are already in my portfolio, but some of them are still on my watch list and will definitely be added when the time is right. I'm very excited to see what you guys think about this list, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, first stock on this list is Waste Management. Waste Management focus on collection, transfer, recycling and disposal services. They are the leading developer, operator and owner of waste-to-energy and landfill gas-to-energy facilities in the United States. Waste Management stock, ticker symbol WM, is down just 4% year-to-date, while the S&P 500 is down 20% year-to-date. Waste Management has a dividend yield of 1.7% and an annual payout of $2.6 a share, or $0.65 per quarter. Payout ratio sits at 46%, meaning there is 54% left in cash to buy back shares, pay down debt and do acquisitions. You want this number below 50% for a defensive dividend stock, so this looks all good to me. Typical for a defensive dividend stock are the lower growth rates. Waste Management has a 8% dividend growth rate, which is pretty high for a defensive dividend stock, and also very good in my opinion. They grew the dividends for 19 years in a row. Overall, this looks very good. Waste Management is a 64 billion market cap company and has a PE ratio of 33, which is a bit high for a slow-growing defensive company. So you pay a premium for the stock right now. Revenue is growing very nice and steady since 2016. There was a small decline in 2020, which is related to the coronavirus. Right now, profit margin is at 10%, which is the exact minimum I want, so keep an eye on that number. For a dividend stock, it's important to have an increasing free cash flow, since this is used to pay down debt, but also to buy back shares and of course to pay the dividends. In this graph we see that it is increasing quite nice and steady, so this is something that I really like about this company. They use this free cash flow also to buy back a decent amount of shares. In this graph we see that shares outstanding are decreasing, which is a good thing. With less shares outstanding, the total amount of dividends paid is decreasing as well, which makes it more easier to maintain the dividends and of course to increasing them. So this is also very nice. Return on assets is below the 10% minimum right now, but it's not that big of a problem for me. Return on equity is sitting at 26%, which is quite good, and return on invested capital is also below the 10% minimum, but it's almost there, so that's not a big problem. Especially since it's higher than the 5-year average, so I think they will do fine. And an important thing for me is the total amount of debt. You want the company to be able to pay off a big chunk of the total debt. The ratio I use is long-term liabilities versus the 5-year average free cash flow. You want this ratio to be below 5. Waste Management is currently at 8.9, which is a bit too high. But okay, free cash flow is growing, so I expect that this number will go down in the coming years. My final conclusion on Waste Management is that I really like the business. They are the market leader and waste always needs to be collected, no matter what. The dividends look really good and they have proven to be a steady defensive dividend stock. And that's why you also pay a premium for the stock. A lot of people just love Waste Management. Next stock on this list is Procter Gamble. They manufacture and market consumer products. The company's products include conditioners, shampoo, male and female blades and razors, toothbrushes, toothpaste, dishwashing liquids and so on. Procter Gamble stock, ticker symbol PG, is down just 10% year-to-date, while the S&P 500 is down 20% year-to-date. They pay a 2.5% dividend yield and an annual payout of $3.65 a share, or $0.91 a quarter. Right now, payout ratio sits at 60%, which is a bit too high in my opinion. They have 40% left in cash to pay down debt, buy back shares and do acquisitions. The dividend growth is at 5%, which is typical for a defensive growth stock. They grew the dividends for 65 years in a row, which is quite impressive. Procter Gamble is a 350 billion market cap company and has a PE ratio of 24, which is a bit of a premium for a company this big and also a slow growing company. Since 2016 the revenue is going up quite nice and steady. Procter Gamble sold off some divisions, so that's why revenue can make a big jump historically. Profit margin is at 18%, which is quite good, and it's increasing over a longer period of time, which is also very nice. Free cash flow is going up and down quite a lot, but since 2017 it's growing consistently again, so that's very good. But keep an eye on this pattern. Shares outstanding are decreasing a lot, which is a good thing. This makes it more easier to maintain the dividends and of course to increase them. Return on assets, return on equity and return on total invested capital all look good to me. You want these numbers above 10%, so this looks very good. Another great thing is that they have enough cash on hand to pay down a big chunk of the total debt, so this also comforts me quite a lot. My final conclusion with Procter & Gamble is that you might pay a small premium for the stock, but they have an impressive track record with the dividends, and they have a rock solid portfolio of popular brands, which makes this one of the better defensive dividend stocks in my opinion. Next stock on this list is Target Corporation. Target is a general merchandise retailer selling products through its stores and digital channels. The company sells an assortment of general merchandise and food. Target stock, ticker symbol TGT, is down almost 40% year to date, while the S&P 500 is down only 20% year to date. Target made a big decline in May after the earnings, so this might be a perfect moment to buy this dividend stock. Target pays a 3% dividend yield and an annual payout of $4.32 a share, $1.08 a quarter. Payout ratio is only at 28%, which is very low, so this looks really good to me. The 5-year growth rate is at 8% and they grew the dividend for 54 years in a row, which is quite impressive. This scorecard looks very good in my opinion. Target is a 66 billion market cap company with a PE ratio of just 11, meaning this stock could be undervalued, especially compared to the companies we discussed before. The revenue is going up really nice and steady, so this looks very good to me. The big jump in 2020 is related to the Roni virus. Profit margin is at 5%, which is a bit low, especially since it took a decline in the recent quarters. But a lower margin is very typical in this industry in general, so that's not worrying me at all. But the decline is related to the inflation, so keep an eye on this number. Free cash flow is not really consistent, but it's going up in the long run, so that's all looking good to me. But I prefer a bit more steadier growth here. Target is buying back a lot of shares, which is very nice. This makes it more easier to maintain the dividends, but also to grow them. Return on assets seems a bit low at 7.9%, but return on equity is very nice with 44%, and return on invested capital is also a bit low with 6.8%. So keep an eye on this number, especially since the 5-year average is significantly higher. Target has more than enough cash on hand to pay down a big chunk of the total debt, so that comforts me quite a lot. My final conclusion with this stock is that I think Target is an interesting price area right now, after the big drop in May. All fundamentals look very good and they have an impressive dividend scorecard, so all reason to analyze this company a bit more and add it to the watch list. Next stock on this list is Church & Dwight. Church & Dwight is the leading producer of baking soda in the world. Beyond baking soda, the products in its portfolio have a vast category reach, including laundry products, cat litter, oral care, deodorant, and so on. Church & Dwight stock, ticker symbol CHD, is down just 7%, while the S&P 500 is down 20% year to date. They pay a 1.1% dividend yield, which may be a bit low. The annual payout is at $1.05 a share, or 26 cents a quarter. Payout ratio is at 33%, which is very nice. The 5-year growth rate is almost at 7%, and they grew the dividends for 19 years in a row. I think this looks very good and steady, but I prefer a little bit higher dividend yield. Church & Dwight is a 22 billion market cap company with a PE ratio of 28, which means you pay a premium for the stock right now. So let's find out why people love Church & Dwight. Revenue is going up very nice and steady, so this looks really good to me. Margins are also increasing in the long run, so that's also looking very good. Right now the profit margin is at 15%, which is above the 10% minimum. The free cash flow is growing very nice and steady, so this comforts me a lot and looks really good to me. You want a company like this to have an increasing free cash flow, since dividend yield is very low. It makes it more easier to increase the dividends or invest it in the business. CHD is also buying back a lot of shares, which makes it more easy to maintain the dividends and to increase them as well, since total dividend paid is going down by decreasing the total shares outstanding. So this looks very good. Return on assets, return on equity and return on invested capital all look good to me, especially since the 12 trailing month ROIC is higher than the 5-year average. Another thing that I really like about Church & Dwight is the fact that they can pay off a big chunk of the total debt, so this comforts me a lot. My final conclusion on this stock is that they are maybe worth the premium. All fundamentals look very good, and with an increasing free cash flow, I think they will increase the dividends as well. So this 1% dividend yield will definitely grow in the coming years. Next stock on this list is Tyson Foods. Tyson Foods is the largest US producer of processed chicken and beef. It's also a large producer of processed pork and protein-based products on the several brands. Tyson Foods stock, ticker symbol TSN, is down just 3% year to date, while the S&P 500 is down 20% year to date. Tyson Foods pays a 2.60% dividend yield and an annual payout of $1.84 a share, or 46 cents a quarter. Payout ratio is just at 18%, which is very low. They have 82% left in cash to buy back shares, pay down debt or to do acquisitions. The 5-year growth rate is at 17% and they grew the dividends for 10 years in a row, so the dividend growth is very impressive here. Tyson Foods is a 30 billion market cap company with a PE ratio of just 7.5, which is very low and could indicate that this stock is undervalued right now. Revenue is growing very nice and steady over the past years, and they are one of the market leaders in this industry. Margins are increasing over a longer period of time, so that's very nice, and right now it's at 7.9%, which is very typical in this industry, so I don't mind being below 10% with this company. Free cash flow is also going up quite a lot in the past years, but it's not always consistent, so I think it's a good thing that it's going up, but I prefer a bit more steadier and consistent pattern here. The shares outstanding are a bit odd and can dilute you a little bit. In the past 5 years they bought back roughly 1% of the total shares outstanding, which isn't a lot, but as long as they are buying back shares I think it's fine, since this makes it more easier to maintain the dividends and also to increase them as well. Return on equity seems a bit low with 5.4%. You want this number above 10% at least. Return on equity looks good with 22% and return on invested capital is also below the 10% minimum. But the thing that I like here is that the 12 trailing month return on invested capital is higher than the 5-year average, so that's looking really good. Tyson Foods has a bit too much debt compared to the free cash flow, so that's something to keep an eye on. You want this number to be below 5, so it's not that big of a problem, but just check it from time to time. My final conclusion with this stock is that I think it's a great company with a steady and consistent revenue growth and also great dividends. Especially the dividend growth is very nice. Debt is a little bit too high, so it would be nice if they start paying off debt and also to buy back a little bit more shares. Next stock on this list is Johnson & Johnson. Johnson & Johnson is the world's largest and most diverse healthcare firm. Their main divisions are pharmaceutical, medical devices and diagnostics, and consumer. The drug and device group represents close to 80% of sales and drives the majority of cash flows for the firm. Johnson & Johnson stock, ticker symbol GNG, is up 4.6% year to date, while the S&P 500 is down 20% year to date. Johnson & Johnson pays a 2.5% dividend yield at an annual payout of $4.52 a share, or $1.30 a quarter. Payout ratio is at 43%, which is very nice. This means they have 57% left in cash to buy back shares, pay down debt and do acquisitions. The 5-year growth rate is at almost 6%, which is typical for a defensive stock. They grew the dividends for 59 years in a row, which is very impressive. G&G is a 471 billion market cap company with a PE ratio of 23, which means that it's almost at its fair value. Revenue is going up quite nice and steady in the long run, so this looks good to me. Margins are also looking good in the most recent years as they are increasing. As of this moment, profit margin is at 20%, which is above the 10% minimum, so this looks also really good. Free cash flow is up in the long run, but it's not always consistent, but this also may be related to the coronavirus. But for me it's very important to have an increasing free cash flow, since this is used to buy back shares, pay down debt and also to pay dividends. Johnson & Johnson bought back a decent amount of shares, which makes it more easy to maintain the dividends, and of course increasing them. So this looks good to me. although I prefer a bit higher buyback rate in the past 5 years since it's at only 3% buyback. But as long as they are buying back shares, it's all good to me. Return on assets, return on equity and return on total capital all look good to me, so this comforts me a lot. Another thing that I really like about G&G stock is the fact that they are having more than enough cash on hand to pay down a big chunk of the total debt, so this comforts me a lot. My final conclusion with this stock is that it's one of the most popular dividend defensive plays in the market, and for a reason of course. They are steady and consistent and have a proven dividend track record. There's not a lot of growth, but you also can't go wrong with owning G&G, so this might justify the small premium you pay right now based on the PE ratio. The next stock on this list is General Mills. General Mills is a leading global packaged food company that produces snacks, cereal, convenient meals, yogurt, dough, baking mixes, ingredients and a lot of other things. General Mills stock, ticker symbol GIS, is up 12% year to date, while the S&P 500 is down 20% year to date. General Mills pays a 2.85% dividend yield and an annual payout of $2.16 a share, or $0.45 a quarter. Payout ratio is at 51%, which is around the maximum you want. The 5-year growth rate seems very low with 1.2% and it grew the dividends for only 2 years in a row, so there's not a lot of growth there. General Mills is a 46 billion market cap company with a PE ratio of 20, which means it's fairly valued right now based on the PE ratio. Revenue is going up and down in the past decade, but since 2017 is quite steady and consistent, so keep an eye on the revenue. They might sold off some divisions back in the days. Margins are increasing over a longer period of time and right now the profit margin is at 14%, which is above the 10% minimum. Free cash flow is up quite nice and steady except for 2020, which is related to the Roni virus. For General Mills, it's very important to have an increasing free cash flow since this is used to pay dividends but also to increase them. So with an increasing free cash flow, it's more likely that dividends will increase as well. General Mills issued roughly 5% new shares in the past 5 years, which is something I really don't like. But since 2021 they start buying back shares, so this part comforts me again. So keep an eye on the shares outstanding with this one. It's very important to have a decreasing shares outstanding since this makes it more easier to maintain and increase the dividends. Return on assets seems a bit too low at 7.9%, but return on equity looks very good at 23%. Return on invested capital is above the minimum of 10%, but not by much, so keep an eye on that number as well. General Mills has a little bit too much debt compared to the free cash flow, but since it's at almost a healthy level, I don't think this is a big problem. You want this number below 5, so check this number from time to time. My conclusion on this stock is that it really looks good in terms of fundamentals and dividends, except for the dividend growth. But since they just started to increase the dividends again, it might be on track to become one of the better defensive stocks to own. Last stock on this list is Coca Cola. I think it's fair to assume that we all know Coca Cola, of course, but here we go. Coca Cola is the largest non-alcoholic beverage entity in the world, owning and marketing some of the leading carbonated beverage brands such as Coke, Fanta and Sprite, as well as non-sparkling brands such as Minute Maid, Georgia Coffee, Costa and Glaceau. Coca-Cola stock, ticker symbol KO, is up 8.5% year to date, while the S&P 500 is down 20% year to date. Coca-Cola pays a 2.7% dividend yield and an annual payout of $1.76 a share, or $0.44 a quarter. The payout ratio sits at 70%, which is quite high to be honest. You want this number to be below 50%. Right now they only have 30% left in cash to pay down debt, buy back shares, research and development and acquisitions. The 5-year growth rate sits at 3.6% and they grew the dividends for 59 years in a row, which is really impressive. Coca-Cola is a 279 billion market cap company with a PE ratio of 27, which means you pay a premium for this stock. But it might be justified since this is one of the most iconic brands in the world. So let's find out why people love this stock. In the long run, revenue is going down. This is also because more and more people are trying to eat and drink more healthier and PepsiCo gaining market share in the restaurant chains. But in the past years, revenue went up again, so that looks really good. Margins are also going up in the long run and right now it sits at 25%, which is very good in my opinion. Coca-Cola has an increasing free cash flow, which is very good and also looks quite steady except for the 3-year period. You want them to have an increasing free cash flow since this is used to pay down debt, buy back shares and pay dividends. And since the payout ratio is very high, free cash flow needs to grow quite a lot to compare it or bring it down. A thing that I don't like about Coca Cola is the fact that they dilute you as an investor with issuing new shares since 2019. This also means that the total amount of dividends paid is going up, and so is the payout ratio. So to be honest, this is not looking really good and is a big red flag for me. Return on assets is a bit low with 8.6%. You want to have at least a 10% minimum. Return on equity looks really good with 44% and return on invested capital also looks very good at 14%. It's also higher than the 5-year average. Another thing that I don't like about Coca Cola is the fact that debt is too high compared to the free cash flow, so this is also something to keep your eye on. My final conclusion is that Coca Cola is one of the most iconic brands, of course, and the dividends look quite impressive, except for the payout ratio. Personally, I don't really like the stock, but I do love the company itself. I think you can't go really wrong with owning Coca Cola as a defensive stock. But at this valuation and dilution, I think it's better to pick one of the others in this list. So this was the full video on defensive dividend stocks. I think in times like this, it's always nice to have a few of them in your portfolio to calm things down and keep bringing in the dividends. But keep in mind that there's not a lot of growth with these stocks as well. So remember to always do your own research and never fully trust what I or other YouTubers say about stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.